It's a financial management as divided into it's a three functions, right? Those functions can be under it's a financing decision, right? Financing decision. What is a financing decision is all about? It is all about how we are going to raise the funds. For that, what you have to study? You have to study that what are the sources of funds? What are the sources of funds? Then second is what is that cost of those funds, which is nothing but cost of capital, right? So then you have to study that, okay, you have to mix the capital. There's a proportion. What does it mean? You are taking the combination of different sources. That is called, it is a capital structure theories, capital structure decision. Here we have studied different theories like net income approach, net operating income approach. Next, it's a traditional approach. And we have studied about what? We have studied about Modigliani-Miller approach. So that also we have studied twice. How? Because first he did not consider the corporate tax. Next, he has considered the corporate taxes, right? So that is the one thing. Next, it is all about leverages. So what are the different types of leverages we have seen? What does it mean of leverage? Leverage means it is a taking an advantage. Now, there are firms, unlevered firms. Unlevered firms means they run the business only based on equity. There is a levered firm. So levered firm here, what? It is equity plus debt. Equity plus debt. Right. So this is the one thing. Next, we have moved to investment decision. Investment decision. So in this investment decision, we have classified into two. What is that? Long-term purpose, long-term and short-term. So long-term, yes, you have used some capital budgeting techniques and you evaluated the projects whether to invest or not, right? It's a capital budgeting technique, where we have studied about NPV, IRR, modified IRR, profitability index, payback period, ARR, accounting rate of return, right? So now left out portion is here, left out in this. And yesterday we have discussed about that. It is a third decision, which is dividend decisions. So where we are going to discuss that, first we have to decide whether to pay dividend or not. If we are ready to pay, how much to pay? Something you are paying some percentage means the rest of the amount you are just returning in the business, right? So whether that dividend payment will affect on the price or not, we have seen yesterday using the Walters model and Gordon model. And also he said that no, its price will not change because of this dividend you pay or not, which is the irrelevance theory. So whatever the market price is going to be dependent on the capability of the firm to earn money. Means if they have good projects, yes, they can or automatically investors are ready to invest in that company. Correct? So that is what we have finished. The last area, which is all about, is a short-term area. So what is a short-term area? Here you have studied about that equity and debt. This is related to financing decision. And here you have studied about non-current assets. Right. So rest of the thing is it is all about your current assets and current liabilities in the balance sheet. In the balance sheet. So whenever you recall the balance sheet, you remember these five components. One is equity, second is debt, third is current liabilities. And this is the fourth is non-current assets, and fifth is the current assets. Easy way to understand the balance sheet. Right? So when I say it is a short term, so within a year. So that's why we say current assets. Current assets means assets which can be converted into cash, assets which can be converted into the cash within a year. within a year. And what are the current liabilities? Let me give the example. What are the current assets? Current assets could be your inventory, your cash in hand, okay, and cash at bank, cash at bank, and debtors, debtors, bills receivable, so on. Even prepaid. Saujanya gar,
Sorry,
can
sir.
okay, okay. So prepaid expenses, right? These are the things. Then what are the current liabilities? Current liabilities are the liability which you obligated to pay within a year. Within a year, right? So for this, you have to maintain working capital. What is the working capital and all? We will study first why it is so important. Because this chapter is very important. You might have, for example, in a personal finance, you see, you have building, means you have a field or something, and you have a gold or something. Okay, but to pay day-to-day expenses, you cannot sell those assets and you pay, right? Means if you don't have enough liquidity, that will be interruption in your business. So that's why this liquidity, when you say about that, so will you be able to survive in the short run is very important. Okay, please understand this. Most of the companies, okay, it is not that they are getting distressed, means they are into the losses, not because of that they don't have good infrastructure or good fixed assets. The problem is that it is a working capital. Working capital. Good example, you see, what you can say is Kingfisher's business, Vijay Mallya. So they have plant, okay, they have assets, so many assets. So the problem with that airlines and suddenly the prices has gone up, okay, and the business got distressed, right? So now we are moving on to the short-term funding, short-term funding. Spend some time on this because this is a 2 hours. We are going to look at what is working capital. We have three components. So one is cash, one is inventory. Okay. So one is what I can say receivables management that we are going to look at. First, in the first hour, we are going to look. It is all about working capital and estimation of working capital. What does it mean? Look at. Now, working capital is nothing but it is a difference between 1 second. Hmm, 1 second, 2 minutes, 2 minutes. So I'm sorry. Yeah. So now concentrate here. What is the working capital? Just now I have mentioned it is working capital is all about current assets and current liabilities. Correct? Now in this case, sir, why we will take its current liabilities also? Working capital means, for example, 1 crore is there. So out of 1 crore, I have invested 80 lakhs in the fixed assets. Okay, 20 lakhs in the current assets. But you will get indirect finance. What is that? Suppliers, for example, here inventory is there. Inventory. When you get inventory means raw material on credit basis, definitely that amount also will be there. Correct? Apart from cash, what you paid, whatever you get the indirect means it's kind of a credit. On credit basis, if you take this asset will be more. Correct. So that's why it is current assets and current liabilities are related to working capital. Working capital. Generally, you can see that this is
Sir,
a
sorry to
difference.
interrupt you. Can
Yes,
you
ma'am.
explain it again, sir, from starting like 1 crore amount?
Yeah, yeah. So, for example, generally you are raising the
Sir,
funds.
sorry to interrupt. Your volume is little low, sir, today.
Actually, I'm in office, ma'am. That's why. Okay, I will increase. I will increase. Now is it okay, ma'am?
Please, sir. Thank you.
Okay, okay, okay. So, for example, you see here equity is there. Okay, and debt also there. These are the sources of fund. I have raised from these instruments 1 crore. This 1 crore going to invest in the assets. What type of assets? One is non-current assets, which is fixed assets. Another one is the current assets. Right. For example, in this case, 1 crore means maybe 80 lakhs I have invested here. Okay, and 20 lakhs I have invested here. Now, apart from this is a contribution. But you see, under current liabilities, you have creditors. Creditors means who are the creditors? Suppliers. Suppliers. Right? So these suppliers indirectly they are financing. Indirect finance we call it as. What does it mean? So they are giving raw material now. Okay. So then they are getting money later. Means these current liabilities are there. These current assets includes inventory. Maybe you bought some inventory with the out of this cash something. Okay, maybe it is a 15 lakhs. Okay, now suppliers has given 10 lakhs raw material on crate. That is also will come into here, right? So now what I'm trying to say, current liabilities are indirect finance to the firm, apart from this funding, apart from this funding. Yeah, did you get this point, ma'am? Did I clear this doubt?
Yes, sir.
Okay, so that's why what we say. So we are going to see the difference between these two. What is the difference? Current assets minus current liabilities. So that is called net working capital. Net working capital. Let me explain. What are those? Okay. So for example, this is a working capital nature is, yes, as I mentioned, it is for the short term. Short term. What it deals with? Short term assets and short term liabilities. So what are those? Those are expected to be converted into cash or they are going to pay in 1 year. Next. Second is it is a circulating or flow concept. Why? What is that flow concept here? Let me talk about this operating cycle. This operating cycle means I have cash, right? So that I have to buy raw material. Then the raw material going to be converted into the semi-finished goods, which is called work in progress. Then we are converting into the finished goods. These goods you can sell it in the market, assuming that you are selling at a credit basis. So then debtors will come into the picture, right? So the debtors will pay you cash. This is a circulation. Generally, I have to tell you that this is a operating cycle. This cycle will be continuous process because until unless your business is existence, you have to continue this process. Means buying raw material, process it and sell and again buy raw material. This is a continuous process, right? So continuously the form cash into inventory to receivable, then back to the cash. Means this is a continuous process. So that's why we call that it's a circulating capital. Working capital is nothing but circulating. Most of the people, okay, if we ask the question, what is working capital? Working capital is a fund which is used for day-to-day operations. Simple understand. So that is nothing but it's a regular functioning. Regular functioning for what? Purchasing raw material, paying wages, or any other expenses which are related to operating, Right. Then this is a dynamic. So why it is dynamic? Because working capital is not a fixed one. And you see, for example, when you are investing in the long-term assets, maybe how many times you buy? So one machinery, okay, one furniture set, one equipment you will buy, correct? But working capital, whatever you are talking about, current assets related, those are dynamic. Why it is dynamic? Means it's keep changes. What is that keep changing? Example, can I say that sales? If you wanted to increase our sales, whatever required working capital will be more. Correct? So you look at that the seasonality means based on the seasons. For example, during the festival season, yes, you need more working capital because you have to keep ready the product. Okay, whatever the services, right? So those are in the dynamic in nature. Next. So influences profitability and liquidity. For example, if you have adequate working capital, so then I don't have any problem. Means ensuring the liquidity and smooth operations. But at the same time, excessive working capital may reduce your profitability. So why? For example, I under current assets, I kept 10 lakhs, but I don't need that much. Okay, so in the cash balance. Unnecessarily, why do you keep your business, your fund idle? Any businessman, they will not keep money idle. Whatever the minimum they have to maintain in the cash balance or bank balance, whatever you say. So they have to maintain whatever extra is there. They have to reinvest. Okay, they have to reinvest. Reinvest in what? So reinvest in the production or reinvest in the any instrument so that you should not keep idle. Got my point? So then it's depend on the nature of the business also, right? For example, some businesses, maybe it's a fast moving consumer goods are there because you need more working capital because you have to produce more and more because it is a fast moving goods. You look at the DMart and whatever the Reliance Mart and all means they keep changes, right? So people will utilization is more, and it is a time element because it is related to the yeah, Bharat Raj. Can you mute yourself? Hmm. Okay, so then it's a time element. It's a time element because it is related to the
అదే అప్పుడే వచ్చేది వచ్చి కూర్చున్నారే ఇంకా మీ లోపల ఉన్నాను అని లోపల కూర్చున్నా
Bharatraj garu, can you mute yourself?
ఇక్కడ కూర్చున్నా
Bharatraj garu, can you mute yourself? Thank you. Yeah. So this is a time element which is related to the short term, You see, this working capital basis of concept. basis of concept you see. One is gross working capital, another one is a net working capital. What does it mean? So this is a balance sheet. We have current assets. The total current assets, we call it as a gross working capital. Okay, so total current assets. But we have even current liabilities. Okay, so from this current, because you are going to pay these current liabilities using these current assets. I think, do you have ratio analysis in the first semester? Ratios analysis, current ratio or something?
No, sir.
Okay.
Mm.
No, okay, no problem. Yeah, so using these current assets, you are going to pay these current liabilities. Okay, what are the enough cash balance, enough bank balance? Okay, will use for this current liabilities. Now you can see this the formula current assets minus current liabilities is nothing but what is the net working capital requirement. This is a net working capital requirement. So on this, we are going to solve some problems too. Some problems too. Keep it aside. Now, sometimes there is a permanent working capital, temporary working capital. So permanent means always we have to maintain minimum working capital. But temporary working capital, you see, according to the season, you have to increase, right? Sometimes in the season, in the sense, maybe festival season or something, you look at sweaters and all in the winter season, ice cream or cool drinks in the summer season, kind. That is what I am trying to say, based on the season or based on the occasion. So that is called, it's a variable. Now you look at this. Permanent working capital means minimum I have to maintain this working capital. But variable, it is going to change according to the demand. Okay. Or according to the season, according to the occasion. What could be anything. That's why this is called, it is a variable working capital. Variable working capital. Got my point? Are you clear? One basis is that gross working capital. When you heard this word gross working capital means total current assets. When I say net working capital, from current assets, you deduct current liabilities, then you will get net working capital. Are you clear? Are you clear?
Yes, sir. Yes, sir.
Yes. Now, investing. Again, whatever I explained, you see, whatever I have explained about, okay, this amount. So this is equity, debt, 1 crore. Now, people will decide this. Say, how much I should keep it for long term, how much I should keep it for short term. That is a question mark. Say, example, if I ask one person, this is first one is long term, second one is a short term. So let me write long term, short term. Some people say, I'll keep it 80 and 20. That is enough for me. But some people they say, I'll keep something 50, 50. Some people they say that I'll keep 95, 90 full in the long term. 10 is enough because whatever that money is there, that I will going to repeat. Repeat in the sense I will buy my goods. If I produce, okay, then sell it, get the money, then I can make it very fast. So like this, people are different kinds of people will be there in the organization. Now they have to take a policy. They have to take a policy that how much I should retain in the working capital. In this case, you look at three kinds of policies are there. Three kinds of policies. One is aggressive, conservative, and moderate. Let me talk about in the personal finance. In the personal finance, you see, some people, they wanted to take risk. They have 1,000 rupees. They wanted to take risk, means they are taking risk, means they are expecting more return. Those people, you see, for the youngsters, you give 1,000 rupees. Where do you invest if you ask? They say that I'll put it in the stock market. That is aggressive nature. And you just give it to the retired person. So they say that I will keep it in the fixed deposit or something because I don't want it to lose this money also. Then middle-aged people, they say that some are, they will invest in the uh, stock market. I mean, in the stock market means risky projects, and 50% or some percentage in the regular income. Correct? Do you agree with me? That is in the personal finance. That is a different types of investors. Those people we say that risk averse, risk takers, whatever you call it as. But here, aggressive people. Aggressive people, what they do? They will put very minimum in working capital. Okay, because they say that, which means entity does not hold lower level of inventory, follow strict credit policy, keep less cash balance. I don't want much. I don't want much. Okay. So that's why they wanted to maintain very minimal. Okay. They say that if they give for 30 days credit period to the customers means yes, at any cost they will collect. That confidence they have. Then conservative people. So they say that yes, choose to invest high capital in the current assets because these people are like a risk averse means they don't want it to take much because they wanted to keep inventory level higher. Oh, because I may not produce immediately when I get an order. So that's why I'll keep in the go down as a safer side and follow the liberal credit policy. Means for some people they'll give it for 30. Somebody they negotiate, they'll give for 40 days. And cash balance also high because tomorrow if I wanted to pay the bills, I have to maintain the cash. This kind of nature. And moderate people, they're going to balance. They're going to balance, right? That you can look at in this. Okay, the three approaches. These are the graphs. You see, whatever can you recall whatever in balance sheet I explained? See, whatever this is the amount 1 crore which I am talking about. These people they say whatever the amount is there, some they will invest in the fixed assets, some some amount they'll keep it as a working capital, then variable will be like from short term debts. Let it explain. So I will not tell you what is that meaning. Yeah, here it is matching is there, but let it go. Let me go to the next one, then you will understand. See, aggressive people, you see, aggressive people, what they do, whatever this line you look at this line, they say that whatever amount they have pulled from the long-term sources, they will invest more in fixed assets, very little amount in the working capital. They say that, whenever I need money, there are short-term debt and all I can take. I'm very confident. That's why they don't keep in much amount in the working capital. Aggressive people. But you observe these people, conservative people, they say that whatever the long term fund they'll put some amount in the fixed assets, they will put permanent working capital full, and for the variable working capital also they will keep, saying that they are not that much confident to get this short term fund. Are you able to differentiate? But moderate people, you see, okay, out of that, some amount in the fixed asset, some amount in the permanent, then the rest they're going to get variable will be from short-term debt. These are the working capital policies. Means based on the approach, what approach the company is going to pay, it's depend on the business nature and the risk-taking factor. Risk-taking factor. Hope you got it. Now, maybe for 12 marks, if they wanted to give a theoretical question, this is one of the question they might give you. What are the factors affecting your working capital? Means, how do you say that how much it should be this much amount? That is based on nature of the business. Okay, what is that nature of the business? For example, trading business need more working capital. Why? Because what is the differences between trading and manufacturing? I told you, right? In the manufacturing, I only buy raw material, okay, process it and finish the goods, sell it in the market. But a trading business, for example, I can't produce laptops. What I can do, so I can get it as a dealership, okay, buy at one price, okay, then you add some more profit, you sell it in the market. Okay, because in the trading business, you're going to get large inventory and quick turnover. You're bringing it, you're selling it, kind of, right? So service firms, they need a less working capital because they will not maintain much inventory because they are going to give the services using the fixed assets, correct? For example, you take hospital, equipment, everything will be there. How much inventory you will make? Very less comparative with the other businesses. Your inventory is that some medicines, okay, whatever the day-to-day, what you can say, items which you required. Next, size of the business. Yes, anyway, larger firm. So already volume of operations will be higher. So you need more working capital. Smaller businesses, they need, okay, maybe it's a less working capital. Next, production cycle. So production cycle, did I tell you what is a production cycle, operating cycle? What is that operating cycle? I have explained you from cash to cash to cash. Cash, I have to buy raw material. It will take some time, five days. Okay, I have to convert into the work in progress. I have to convert into the finished goods. I have to sell it and so maybe if the time is more, then I need more working capital. If you are able to make it this process within the less time, so then you need less working capital. When you need more working capital, okay, when you hold so much of money in the some other forms, right? What is the some other forms? You see, first let me tell you what are the current assets. As I told you, cash in hand, cash at bank, inventory, inventory, debtors. Your customers has to pay you. Okay, some prepaid expenses. These are your current assets. What are the current liabilities? Current liabilities are your outstanding bills, and you have to pay your creditors. You have to pay your bills payable. Okay, so this kind of, right? So now you look at business cycle. So what is that business cycle mean? Okay, have you seen this business cycle in the economics? Okay, maybe it is a boom stage, sometimes it is a recession stage, this is a one recovery stage, this is a recovery stage. Based on the situation, means economy. Okay, for example, you are expecting that sales sales going to increase. Then what you have to do? You have to make more production. So then you have to invest more working capital. There's a common understanding. In the recession, you are expecting less sales, maybe in the pandemic time. Example. Okay, then it is a less working capital you need. Next, credit policy. You are following liberal credit policy, means more credit sales. You are saying that whoever comes, you are giving credit sales. Then what will happen? Your money will got stuck. Then to run the business, you need more working capital. Then strict credit policy. If you 30 days means in 30 days you should get back your money. So then in that case is a faster the cash inflow. So then you need less working capital. Next, credit availability. Okay. For example, now can you connect what I explained? If your suppliers are okay, they are ready to give you that raw material and everything on credit basis, you no need to get good amount, right? It's means you need only such a less amount compared with the people who do not have that access. Okay, I am maintaining good relationship with my suppliers. They are just sending the material on credit basis. And after making sales and then the repaying back, yes, I'll get the cash, I'll repay them. But some people, they will not get that. So in that case, you have to pay cash and get it. In that case, you need more working capital. Correct. So these are the few factors which are affecting uh, working capital. Inventory policy. For example, you have to maintain high inventory level, means for the safer side. Then you need more working capital. So efficient inventory control, just in time. Okay, this Japanese system. What they do, whenever they require, they will order. They place the order, they'll get it easily. So not like they will not take much time. They will plan it in such a way. Japanese technology. So those people, yes, they need one less working capital, right? And at the time of growth and expansion, yes, you should have good working capital. And if you wanted to use the resources, okay, that is nothing but inventory turnover or receivable turnover. What is that inventory turnover means? You are making, you are selling. You are making, you are selling. In that case, I don't want it to keep much funds for that because see, first round, okay, I made product and I sold it. Immediately, I'll get a cash. That cash again, I have to invest in the next process. Easy. If you are efficient to in this process, yes, less working capital. But you are taking time from collecting from your customers or selling in the market also, you are taking time. Then you need more working capital. You need more working capital. Next, seasonal factors. Okay, as I told you, it's a woolen garments and whatever ice creams and all based on the peak seasons, right? In the peak season, you need high working capital. Off season, you need less working capital. Dividend policy. Higher dividends reduce the return earnings, correct? Because once you pay, return earnings will be less, less internal funds, then greater dependence on the external working because whatever my reserves, I'm paying most of the amount towards the dividend. Definitely, I have to go to the bank and get working capital. And technology, when you're using technology, automatically your working capital will be less. Why? Because as I told you, working capital is for day-to-day expenses, including your labor charges, right? So now what will happen if you buy good technological machine? Then I should hire very less people. So definitely whatever I pay for them is less. I need less working capital. I need less working capital. Right. So these are the factors. Are you connecting to working capital? Are you connecting? You look at, as I told you, it's a working capital cycle. Working capital cycle. What is a working capital cycle? Cash to cash means I have started with the one form is called it's a cash. Then I bought raw material. Maybe it might take 5 days time. These raw material using other help of labor. So they are converting into the work in progress, maybe taking 10 days time. Okay, then finishing goods for 5 more days and selling in the market, you might take 20 days and you are giving 30 days time period to the your debtors. Now you tell me from this form to again cash form to cash. Let me write cash to cash. How long you are taking time? 5 days, 10 days, 15 days, 5 days, 20 days, 40 days, 40 days, and 70 days. 70 days. So then in that case, 70 days means in the 365 days. Okay, how many times? How many times? It's a 4 plus or something. Okay, how many working capitals can be there? For example, you say you are able to make in the 60 days itself. 60 days means how many times? 6 working capitals you can run. Means 6 times you can do it. But some people they take 90 days. When it is a 90 days, 4 working capital cycle. What is that working capital cycle means? Your process is you are repeating because when you are able to sell it in the market very fast, automatically this is possible. It's depend upon the nature of the business. It's depend upon the nature of the business. Yeah, this is what I have explained you in the similar way, which is all about the operating operating cycle or working capital cycle. So as I mentioned, yeah, this is a time, as I mentioned, but what you have to do is you have to deduct the Kratos time period. Yeah, let me move on to one thing. See, how much should I maintain excess or inadequate? Both are dangerous. You should not maintain more or you should not maintain less. Both are not. You should maintain the adequate one. So what is the disadvantage of inadequate? If no working cap means less working capital, you have a problem with that. So you cannot pay the short-term liabilities on time, and economies of scale is not possible. What does it mean? Expansion is not possible. It's a difficult for the firm to exploit the favorable market situation. Means I can capture the market, but I don't have enough working capital, so I cannot capture. And the day-to-day liquidity problem and improper utilization of fixed assets. Why? You have fixed assets, but you are not utilizing 100%. Then automatically it's inefficient. Inefficient. Next, excessive working capital. If you keep more in the balance sheet, okay, my current assets are so much. That is also not good. Why? Because idle funds, number one. So if you keep idle funds, ROI will be get affected. Next, that is your inefficiency. Inefficiency. And sometimes you're going to give credit policy. Okay, you just come, pay 1 rupee, take refrigerator to home, because your target is that to make more sales. See, you have to make more sales, there is no doubt at all, but at the same time you have to see that whether customer will be able to pay or not. That is, otherwise what will happen? Bad debts. Have you heard about this in accounting? Bad debts will be more. You have to take care of that. And excessive working capital, creditworthiness will suffer. Now you see, you have borrowed so much, your cost is more, but your return is less. Automatically, firm will get into the distress. That's why you have to be very careful. Either it is not much, too much, or it is less. It should be adequate. It should be adequate. Now, everyone, please concentrate here. Now, sir, you are talking about working capital. It should be this much, that much. Sir, how much should be there? How much should be there? That is based on the past information of any kind of business. Because I know about my firm, what I did in the last year, how much it is got stuck, everything I know. Based on that, I have to maintain that working capital. You see, simply, I will let me tell you this pro forma, because this problem you might get in the exam, that is called estimation of working capital. Estimation of working capital. I am going to teach you from your textbook only. You see, what is the working capital? It's a net working capital. What is the formula? Current assets minus current liabilities. Current liabilities. The difference is net working capital. The difference is net working capital. First point. Is it simple? What is that? I will take current assets list, current liabilities list. The difference is between these is nothing but net working capital. Now, one by one, I tell you. You just go, what is this current assets altogether? This is a previous year's information on an average. Look at, you go to the factory. Okay, raw material can be three forms. Did I tell you? Oh, sorry, not raw material, stock or inventory. Stock also called as inventory. Inventory. So this inventory can be three forms. One is pure raw material form. You go to the firm, factory, you can see raw material in the godown, right? So now some raw material already being used at machinery. Can I say that work in progress? Work in progress means what? Semi-finished. Semi-finished. Okay. So then one more is there, finished goods means completed, means ready to use, ready to sell. Okay, can be this, can be this, can be this. When you write in the balance sheet, okay, you know that in the balance sheet you might have already written closing stock. What is this closing stock means? Do you think only unsold stock? No, this includes everything. Raw material, work in progress, finished good. Finished good. Got my point? Now, you go to any factory or any firm. Always, let me take what is this working capital is all about. See, you go to a D-Mart on Monday. On Monday. You see, every shelf is filled with whatever the groceries and everything. By evening, okay, by night or whatever you say. So again, some might be, most of the things are sold off. Next day morning you go, they are going to refill. Going to refill. What does it mean? Every day you are keeping that much worth of raw material or whatever the products just like that means you have to maintain that. So is it for one day? No. It is for 2 days? No. It is for 1 month? No. You have to maintain the same stock for 365 days. 365 days means that much of amount is got stuck. Do you agree with that? Means even though they are refilling, but that much quantity every year you have to keep it, right? That is called working capital. For example, one of the way to understand working capital is that much of worth every day you have to keep it every day. So that is called, it's a working capital. Now you see, raw material on an average, you have to keep it in the go down. Okay, because the buffer stock or whatever you say. Work in progress also will follow. It will say take some time. Finished goods, it will take some time. Next, you're selling it in the market. Okay, datas. Datas in the sense they are also given with some time period, maybe 2 months, okay, maybe 45 days, maybe 30 days. And you might have paid payments in advance, prepaid. This is also your current asset. And you have to maintain some minimum cash balance. Minimum cash balance. This is also your current asset. Then you have to make a total. Now, what are the current liabilities? Okay, I bought raw material on credit basis. Then can I say that creditors and how you have prepaid expenses? Here you have outstanding expenses. This you have to take. Now the difference is working capital, net working capital. From last year to this year, in the question, if they give you, this information is based on the last year's information. If you wanted to keep some, because the prices may fluctuate, right? So whatever the amount you have invested as a working capital last year, that is may not be sufficient this year. You have to make some provision. For example, you have to maintain 1 lakh. They are saying that you just maintain provision 10%. Then compared with that last year, I have to maintain 1,10,000. 1,10,000. So this is called estimation of working capital. Estimation of working capital. But we have to solve problem. This is important. This is important. I am taking from your textbook itself one problem. Otherwise, let me take like this. Yeah. Look at this working capital. When you talk about this working capital, a pro forma of cost sheet is given. Okay. In that, raw material is there, direct labor is there, overheads also there. Because if you combine these, then only the product will be there, right? So total cost of that production cost is 270. They're adding some profit. They're selling at 300 rupees. 300 rupees. This is a cost structure is given. Cost structure is given. Everybody please concentrate here. They are saying that in the last year, first point, raw materials are in stock, in stock on an average 1 month. Means they are maintaining 1 month required raw material all the time. That is 1 month. Let me write this 1 month. Next, material are in process. What does it mean? Work in progress. Work in progress. How much? On an average, half a month. Means 0.5. 0.5. And finished goods, what you have made, they have to maintain 1 month stock. 1 month stock. Okay, very good. So far, did you get what is given? What is given? Next, credit allowed by suppliers is 1 month. Credit allowed by suppliers means suppliers has given raw material on credit basis. Means this is a current liability. Can I say that it is a current liability? Because I have to pay them. Next, it is a credit allowed to the customers 2 months. Means you are giving time period to your customers 2 months because these are the datas. These are the datas you have to receive from your customers. Next, lag in payments. Lag in payments means it is outstanding expenses. How much? 1.5 week. 5 weeks. Whether it is given in the days, whether it is given in the month, whether it is given in the week. Week, month, days. You have to be very careful. Next, lag in payment of overheads 1 month. Okay. And 1/4 of this output is sold against the cash. Okay. That is means 1/4 means 1/4 for the cash and 3/4 for credit. Okay, that is what they are giving. Very good. Then cash in hand you have to be maintained by company all the time 50,000 means all the time that money is stuck. Minimum it should be in your balance. What does it mean? It is got stuck, correct? Yes. Now what they are asking you, look at, you are required to prepare statement of working capital needed to finance. Means how much money you should have to get finance, and level of activity is 2,40,000 in a year. How many units you are producing? 2,40,000. You may assume that production is carried out throughout the year. Wages and overheads accrue similarly, and a time period of 4 weeks in equivalent to a month. Okay, equivalent to a month. And they are saying that there's a 4 weeks means how many weeks it could be in a year? 48 according to the question. Now, is there any doubt regarding this question first? Did you understand? They have
So,
given the cost structure. Okay, so then they, yeah,
see,
anything you're
sir.
asking?
Yeah. So cash in hand and at bank is 50,000. So is it
50,000 each or both together 50,000?
Every time, whenever I see your cash balance, bank balance, it should be 50,000.
Means
Means,
both together
yeah,
and bank.
together, put together, yes, put together.
Thank you.
So generally, nowadays, ma'am, you might have studied cash flow statement. Cash in hand, cash at bank, consider as a cash and cash equivalents. Okay, both are same. Nowadays, now we are using digital wallet. We don't make any difference, right?
Okay,
Right.
thanks.
Yeah. So now, what you should know? What are the current liabilities? What are the current assets? You should know first. As I told you, current liabilities are, one is you bought raw material from suppliers, that is your current liability. Then what you supposed to pay lag in payments, wages, overheads is your current liability. Correct? So what is a procedure you understand? Maybe in the first sum itself, whether you will get it or not, it is okay. But look at first thing, according to the adjustments, raw materials are, as I told you, three forms. What are the three forms? One is pure raw form, it is a raw material form. Second, it is a work in progress form. So then there are in the finished goods form and in the debtors form. This you should remember, because these current assets could be like this. Current assets could be like this. Did I get any? Now, is my voice clear? Is my voice clear?
Yes, sir.
Okay, okay, okay. So now you see, one by one I am taking. First, I'll take raw material form. Raw material, it is a 1 month, 1 month. So now you see how many units you are producing? 2,40,000. First, I will write like this. Let it be like this. Let me write first. You should take 2,40 units into, okay, just leave this. What I'm writing, just you take it. Okay. So what is the raw material cost? Raw material cost is 140. 140. Next. This is for what are they saying? They are saying that so time period is a 4 weeks equivalent to 1 month. So because some are in the month, some are in the weeks, that's why they're considering in the weeks. 1 month means how many weeks? How many weeks? 4 weeks, right? 4 weeks. What I take, this I am going to take 4 by 48. 4 by 48. You see, my total year, my units are 2,40,000. Raw material cost is, it is a 140. In that, this is a total cost. This conceptually you'll understand. 2,40,000 into 140, we have converted into the value. Now, how much value of raw material is got stuck every month? Which is 4 by 48. Why I have written 4 by 48? So if they would have not told weeks and all, directly I would have taken 1 by 12, because for 1 month. 1 month means it is 1 by 12. 1 by 12. But they have considered in the weeks. That's why 1 month means 4. 12 months means 48. That's why 4 by 48. Let me check this once. 1 second. Let me calculate this. 2,40,000 into 1,140,000 into 4 divided by, let me take this, 8. Yeah, 28 lakhs, correct. Okay. So this, you got it? Do you have any doubt regarding this? Please ask me. Please ask me. Okay, hope you got it. Next, work in progress. Work in progress means semi-finished. In semi-finished, what all will be there? Raw material will be there, labor will be there, overheads also you might have used it. Correct? Correct? Now, you see, in the same procedure, because this is a work in progress combination of these three elements. Number one, let me leave this one. First, raw material I will take 2 lakh 40, 2 lakh 40 into what is the raw material cost? 140 into how many weeks? Half a month means it's a 2 weeks. Can I write 2 by 48? Next, labor 2 lakh 40 into what is the labor cost? Labor cost is 60. 60 into 2 by 48. Next, 2 lakh 40 into what is the overheads cost? 70. 70 into 2 by 48. Now you will get this and total you should write it here. Next, finished goods. Finished goods how many weeks? 4 weeks. 4 weeks. Here you can repeat again. You can repeat again. So without repeating, I can do one thing. What I can do, you know, finished goods means total cost, right? So I have used raw material, I have used labor, I have used overheads. Can I take it 270 directly? Okay, I can take, you can take separately also. 270 into 4 by 48 days, the 48 weeks. 48 weeks. Got my point? Got my point. Next, Sunday datas. Sunday datas are 2 lakh 40 into here. Generally, there is a key point here. What rate you're selling? 300. 300. What is our profit? 30. What is our cost? 270. When you are arranging funds, do you arrange 270 or do you arrange 300? When you wanted to make a product, do you arrange 270 or do you arrange 300?
270.
270. Very good. If you got at this point, it is over. Means Sunday data because we don't include profit. Okay, because we cost which is stuck with the Sunday data, that only I am going to take. It's 270 into, but directly I can take 8 by 48. But what happened? Out of these sales, 3/4 sales only on credit. 3/4 sales only. Because 1/4 is cash. Cash I already got it. So that is not stuck. How much it is amount is stuck? 3/4 only. That's why they are going to multiply with 3/4. Okay. This is also clear. Then cash in hand anyway you have to maintain every month or every week, it is a 50,000. Now this is your total current assets. Now there are current liabilities. What is that current liability you see? Okay, your suppliers are given time how much? It is a 1 month time. Means how creditors will come into the pictures? Only when you buy raw material. So what is your raw material cost? 2 lakh 40 into 140 140 into 4 weeks, no? 4 by 48. 4 by 48 means this much you have to pay. And wages also you have to pay 1.5 week. 1.5 week. And the lag in payment of overheads 4 weeks. Overheads is how much? 3 lakh 50. How do you get it? So how do you get it? 2 lakh 40 into, what is the overhead? 70, yeah? 70 into 4 by 48. 4 by 48. So like this, these are the total current liabilities. The difference, how much you have to arrange now? You have to arrange this amount. How much it is? 1 crore 44 lakhs. 1 crore 44 lakhs. So this is the amount it is required. This is the amount it is required. So then if they tell you, you provide extra contingency, maybe 10%, 12% or something. On this, you have to provide. 1 crore 44 means maybe 1 crore 44. Yes, 10% you remove this, then it is a 440 means 1,44,000 extra you have to keep. Then total net working capital you have to sum up. You have to sum up. This is a working capital. This is the working capital. Yeah, first time it looked like new, but it is very simple. It is very simple. You have to check the time. Yes, yes. You're asking a question?
So I
You're
have a
asking,
doubt.
yeah.
So even if it is 2 weeks, why are we taking it by 48?
Sorry, ma'am. I can't hear you.
So in cases are 2 weeks, and there are 4 weeks, we are taking 48. If it's
Mm-hmm.
2 weeks,
Yeah.
why are we taking 48?
So here they have mentioned that uh, it's a time period of 4 weeks is equivalent to 1 month. In 1 month, they are
Mm.
considering 4 weeks. 4 weeks. That's why 12 months. 12 months means 48 weeks. Otherwise, if they did not mention this particular line, what you have to do? All the time you have to take 52. So they did not say anything, 1 month. So they have considered in the weeks. Then always you have to divide with the 52. For example, if they given that days, you have to take either 365 or 360 because national holidays and all. Even whatever you take, it is okay. When months are there, then it is 12 months. You have to divide with the 12. If days, month, weeks, okay, sorry, weeks 52. But in this problem, they have separately mentioned that, okay, you have to take 4 weeks in a month. That's why I have converted. We'll see other problem for your thing. Here you see this is 4 by 52. Why? Because they did not mention about anything weeks or something. Okay, then you can take 52. 52. Or sometimes only months are given. 1 month, 2 month, okay, and half a month. They might have taken by 12. By 12. By 12. Got the point, ma'am?
Yes, thank you so much.
Okay. So like this, they have to consider. Yeah. So this is all about working capital. Now you take a 5 minutes break, come back in 5 minutes. So we will discuss about cash management first, then inventory management. Okay, cash management, I have to teach one problem. Okay, and inventory management, small EOQ calculation. And what is inventory management? What is cash management? I will talk overall. Okay. Yes. Take a break for 5 minutes and come back immediately. Yeah. Hope you got back because we don't have time. Okay, let us start again. Now, when I say working capital, which is nothing but current assets. As of now, you understand current assets. In these current assets, main components are, one is cash. Okay, so cash and cash equivalents, you can say. Second one is inventory. Inventory, other name, you can say it is as stock. Next, third is your receivables. Receivables means which you're supposed to receive from your customers because you have sold goods on credit basis. Okay, that is receivable. So that we call it as a cash management is separate, and inventory management and receivables management. What cash management will talk about that? You have to maintain the required liquidity. And what is the inventory management? You have to maintain the material, work in progress, and finished goods according to the demand. That is also, it is your duty. Receivables management means you are selling goods on credit to your customers. Selling goods to the customers, is it okay? But how efficient you are able to collect from them is also very important, right? Otherwise, your money is got stuck, right? So that's why you have to study in this working capital management each component separate, each component separately. So now what I do, I'll talk about that cash management, then inventory management thoda, and receivable management thoda, right? Okay. So let me go with the money cash management. In the beginning only I told you, wherever you are applying these management principles, okay, as I told, planning, organizing, controlling and everything that you are applying in the respective domain. So that is called cash management. What they are trying to look at. See, cash management involves planning, controlling, and optimizing the inflows and outflows to ensure that firm should maintain adequate liquidity. Ultimately, this is all about working capital only. Working capital means what? Liquid. Means liquidity means without any problem in the short term position. Okay. This is called cash management. Now, what is a motive to maintain? So why there are different motives. Generally, this is according to the Keynes. They say that you have to maintain your cash for number one, transaction motive. What is the transaction motive? Because I have to maintain money to pay wages, bills, purchases in the organization. That is called transaction motive. Next, precautionary motive. What is a precautionary motive? Means I have to keep some reserves for an unexpected or emergency in the future. You have to maintain the cash. Third, speculative motive. What is that? To take the advantage of unexpected business opportunities. For example, suddenly you get something at a good price. Yes, to get that benefit, you should maintain. Next, fourth, compensating motive. What is that compensating motive? To maintain minimum balance as required by the banks for availing the credit facility. Correct? For example, you maintain good amount, people will call you. Do you need loan? Do you need loan and all? If you are maintaining your CIBIL score or you are maintaining on-time payments and all those things, yes, you will get good, right? So this is a one thing. Next, now the objective is what? Objective is that to ensure the liquidity because sufficient cash is required. Minimum idle cash, minimize the idle cash because in the sense I don't want it to keep more amount idle because I will lose some return and to reduce the cost of financing. So once you have your own money, why do you go and borrow and pay extra interest? No. And to improve the profitability, because through proper cash planning and control, you can make good profits. Next, to synchronize cash inflows and outflows smooth in the business. So what are those cash inflows and cash outflows? You might have studied in the cash flow statement. Okay, some are from what you can say operating activities, investing activities, and financing activities. Here, what are the factors is the same like working capital, which I have mentioned. Because if it is a manufacturing concern, you need more scale of operations, more you have to maintain more credit policy. If you are liberal credit policy, you have to increase your balance more. In the boom stage, you have to maintain more. So more or less same because this is umbrella of working capital only. Umbrella of working capital only. Now, how do you make this balance? One of the way you are going to maintain this balance based on the cash budget. Budget is all about what? About the future. About the future. Now, you have to prepare this budget before only so that you will know how much you have to arrange for the working capital and how much money extra you have so that you can uh, invest immediately. You got my point? Because in a business, based on the previous year's experience, previous process experience, you will know that what my expected sales, what are my expected purchases, whatever expected bills I have to pay, everything you will know. You will know. Accordingly, what you can do, every business, at least they are going to maintain monthly budget. What is the purpose of monthly budget? Once you have, 12 months budget means your income expenses of respective month. Assuming that in 1 month, example in your case, you look at in your personal finance, because once you understand personal finance, you can connect to the business finance. Now schools are open. You already know 2 months back only as you have to pay fees for your children. Correct? For example, you have taken a loan. You know that every month you have to pay EMI, right? And you know that you have to pay milk bill and you have to know that vegetable bill. So these are the common things, right? So already you will analyze that what would be your monthly expenditure, you will know. Correct? That is our point number one on the expenses side. And you also know that, for example, railway people, the employees, they'll get bonus. I think you also might get the bonus at the time of Diwali. Okay, and you know that when you have any fixed deposits or something, you will get some interest. You can expect a few things, right? So in the similar way, businesses also will expect income. They expect what are the expenses. Accordingly, they are going to prepare the budget. Now, this is also one problem related to cash management under working capital. Let me go to that particular one. Mm, Let me take this one. It's a cash budget. Yeah. So this is very easy. You can score immediately, maybe 12 marks or something. Just a simple thing. Look at one problem is enough regarding this. Look at this. Yeah. From the following information, Moon Limited, they are asking you to prepare budget for 3 months, commencing from June. Okay, 3 months means they are asking you to prepare June month budget, July month budget, and August month budget. August month budget, right? But they might have given you previous month, and there is a meaning. I'll tell you. Slowly we will go, right? So now monthly expenses are given, monthly sales are given, monthly purchases are given, monthly wages are given, monthly selling expenses are given, overheads also. This will be related to April, May, June, July, August. Perfect. Now they are saying, look at a sales commission of 5% on sales due 2 months after sales is payable in addition to the selling expenses. Sir, I didn't get anything. They are paying sales commission 5%. But when they are paying, once you make sales in this month, they will pay after 2 months. After 2 months. This is a point number 1. Next. Credit terms of sales are payment by end of the month following of the month of supply. Following month means next month. If you are making sales, you are going to receive in the next month. That is the one thing. On an average, one half of the sales is paid on the due date, while other half is going to pay next month. You see the information. Once you make a sale, so half they are going to pay in 1 month, in the following month. Next half will be paid in the next month. For example, in April month, if you make this one, okay, there is no cash sales, right? Assuming that 50% you are paying in, you are receiving in May, 50% you are receiving in June. In the similar way, if you make sale in the May month, 50% you are going to get following month means next month. In the June month, and half will be in the July month. Your sales June month, why they have given April and May? For this purpose only. If you are making sales in the June month, then you will get in the July and August. July month, you will get half in the August, half in the September, but I don't require. Next, creditors are paid. Creditors are paid during the month following month supply. What does it mean? Why creditors will come into the picture? When you buy raw material, right? That is related to purchase. But what are they saying? Creditors are paid during the month following month. Means if I buy this month, I am going to pay in the next month. Next, plant purchase in the June for 78,000. Means you are expecting that you have to buy a plant which is for which is for which is for 78,000. Now what are you doing? Payable on delivery. Payable on delivery means in the same month, 48,000. In the same month, how much you are paying? 1 second. Hello, ma'am. Hello, ma'am. Cheppandi. Okay. 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 Mm. Okay. Okay, ma'am. Thank you. Yeah, one announcement here. There is an unknown name here, Motorola Edge. Who is that? So this Motorola Edge with the name Motorola Edge, with the phone model name they have joined. Who is that? Yeah, can you respond? Because I got a call from the office. If you can respond, then you will be in the class. Otherwise, they ask me to remove. Motorola Edge. Anybody?
No.
Motorola Edge. So then I am
We
removing
have an
you.
idea, sir. We don't know, sir.
Okay, okay. So then in that case, I'm removing that person. I'm sorry, because according to the rules, I have to do. Okay, sorry. Sorry to interrupt you. Yeah. So next, you see, you are buying a plant in the June month, but in the June month, you're paying 48,000. Remaining is 30,000. That 30,000, they're paying you in the equal installments. In the equal installment in July and August. You see, these are the expected expenses and incomes, right? Next, you have to pay dividend of 30,000 will be in the September. Okay, that is you have to record in the September. But are you preparing that? No, because dividend I am not preparing. And wages are paid 3/4 on due date. Okay, 1/4 on the next month. What are those wages? Yes, 3/4 in the same month. 1/4 I am going to pay in the next month. Next, lag in payment of selling expenses, overheads in 1 month. Means April month amount I am going to pay in May, May month I am going to pay in the June, kind of. Even overheads also same. Overheads also same. 1 month lag. First, did you understand the problem? Did you understand the problem? They are saying they have given sales, purchases, wages in the month, in which month they are expecting. Now they are saying that there are some changes. For example, sales, great sales are there, but the amount, whatever they made sale, that amount they are going to get some percentage in the next month, some percentage in the coming month, like that. So now you look at. Uh, Actually, I have. Mm. Yeah. So for this, there is no answer here. Okay, no problem. Now, what you can do, let me create the slide. One slide. I am going to create one slide because I am talking about this. Okay. What you're supposed to do, first you have to go with the format. What is that format? Particulars. Particulars. Okay, then I need to prepare for 3 months, June, July, and August. August. Then I have to prepare, okay, receipts is here, receipts. Okay, then payments, payments. Then I'll get closing balance here, closing balance. If I want, I can start with opening balance here. So if you have any opening balance in your account, you can start with this. You can start with this. Now you see, after this, what you have to do, you have to create working notes separately. So that working notes, sales you should take. Sales you should take. You take sales. Now what you can say, you can create like this. June, July, August. If you want, you can keep May also. Now, June month sales, you're going to get when? Half I am going to get, sorry, May month sales, you're going to get half in the June month, half in the July month. Again, you take July month sales. July month sales, I am going to get half in next month, like this. You have to create that working notes. You have to create. Here I have made for other problem for your, uh, yeah, this is for other problem, but I'm showing you. Look at this. Look at this. First, I have started with the opening balance. I have started with the opening balance, 37,500. Then what are my receipts? My receipts are cash sales and my receipts are collection from debtors. For this, I have to make working notes accordingly what is given there. Now you know that when you're going to pay your material, okay, production overhead, the selling and distribution overheads, R&D, okay, this all you will be knowing. You will be knowing. So accordingly, what you can say, let me show this format. Now, this closing balance is there, right? So how did you get this closing balance? How did you get? So these are my total receipts. These are my total payments. Rest is nothing but it is a closing balance. This closing balance will be opening balance for the next month. Okay. Similarly, you say that this is a opening balance and this is a opening balance. Sir, why do you prepare this? Why do you prepare this? Because if, for example, here minus balance, minus means in the bracket, if I keep it, it is a minus balance. Assume that. Now you are in the April month or in the May month. You know that there is a deficit in the July month, means you are running out of cash in the July month according to your estimation. Then what can you do? What can you do? You can arrange beginning only. You can, in the June month itself, you can tell your banker saying that I need some overdraft balance in the July month. Okay, for that you can arrange the amount. Means there and there, if you go and get loan, it is difficult. But if you arrange that amount, means you don't take, but you will tell your banker that I may require this much. Okay, you give the approval. So that when you need to pay some obligations, some bills and everything, you can get it. Sometimes your minimum, see, in this August month, you see, in the August month, 2,21,700. Minimum balance you have to maintain is 50,000. 50,000. How much extra you have? More than 1,50,000. Okay, 1,70,000 around. Extra amount, what you can do? You can divert into the investment. So that at least for a month you will get some interest or something, some profit also you can generate. Correct? So that is the way what they can do in this cash budget. What are the expected income? What are the expected expenses they'll make, and they'll see that what would be the probable closing balance every month, so that if I have extra, I can invest rest of the amount. If I don't have a money deficit balance in beginning, in the prior only, I can arrange for the working capital requirement, so that will without any problem I can run my business. I can run my business. So let me show in your textbook. Let me show in your textbook saying how it is. Not this one. You also practice this one, cash budget. Yeah, let me talk about that cash budget. Let me show you. Cash management. Yeah. In your textbook, you can see this budget. You see? Prepare cash budget. Prepare cash budget for the month of May, June, July. Okay. So what is the information is given? So they have given about credit sales, credit purchases, wages, manufacturing expenses, and office expenses, selling and distribution expenses. They're asking you to maintain minimum in the May month, the opening balance is 8,000. They're expecting plant is 16,000, where they pay due for delivery in July, payable 10% on delivery. Means down payment is 1,600 and the rest will be in the three equal month. Means EMI they are going to pay. Advance tax you have to pay in the March and June. Next, period of credit is allowed by the suppliers 2 months, to the customers 1 month. Lag in manufacturing expenses half a month, and lag in payment of office and expenses, it's a 1 month. Now you see every information is given. First, they're asking you to prepare May month, June month, July month. You have to start with the opening balance. What is the opening balance? 8,000. 8,000. Next, what are your incomes? Incomes, you look at your customers are paying you in 1 month. 1 month means you are preparing May. May means whatever April month sales you are getting in the June month. You are getting in the June month. Whatever the 62,000. 62,000. See, 62 in this. Whatever the June month sale you are receiving in the July month in the August. So whatever it is, you got it. These are the receipts. What are the payments? Payments also credit purchases. It's a 2 months. 2 months means if you buy in the March month, you are going to pay in the May month. Okay. In May month, you're going to pay in July. In June month, you're paying in the August month. Like this, I have written. Wages is 1 month. Okay. And plant, you're buying in the July month and paying 10%. Advance tax, they told that they have to pay in June month. So these are the total. Okay. Then difference is so much. Difference is so much. This 13,750 will be the opening balance there. Opening balance. So like this, you can make this cash budget. In your textbook, even it is a very simple manner they have given you. You can practice this. This is the cash budget. Okay. Now, let me talk about that last one, inventory management. Inventory management. Yes. What is that inventory? Inventory includes your raw material, work in progress, and finished goods. Finished goods. So this is also same definition, planning, organizing, controlling of to maintain the optimum level. Here one concept I have to teach you. Okay, what is the inventory management objective you see? Optimum inventory level, because neither too high or too low, and to minimize carrying cost and ordering cost, and smooth flow of your production and sales, because without any interruption, so that you can reduce the risk and you can improve the profit. Here in the inventory management, let me discuss 2 3 points. Number one, okay, let me create you're talking about inventory, right? Inventory. When you're talking about inventory, there are two costs which are incurred. One is ordering cost. One is ordering cost. One is carrying cost. These are the two costs which involved related to inventory. You see, If you, for example, you are into the business, you have to buy raw material. When you buy in a bulk, you will get two benefits. One is you will get a discount, and transportation charges will reduce, because if you buy two times, three times, four times, transportation charges will come down if you buy in the bulk. So then in that case, if your purchase increases, your ordering cost will reduce. You understood that? Array, I will get the discount. So I will buy in the bulk. So then you have to bring it to a factory. Then you see, you have to keep it in the cold store, whatever the temperature. Room is required. Security is required. Okay, so the maintenance charges will be there. What will happen when you buy in the bulk? Your carrying cost will increase like this. Now, there are two ways. Okay, one side is ordering cost is reducing, one side carrying cost is increasing. But you should be optimum. That optimum is all about where my ordering cost and carrying cost is get interrupted. Such quantity you have to buy. This quantity called EOQ. Means what is that EOQ means? Economic order quantity. Economic order quantity. Quantity. So this is 2CO by I root. Okay, what is that? Let me show it in your textbook.
So your screen is not visible.
Is it so? Now is it visible?
Yes, sir. It's visible.
Okay. What I am trying to tell you, so ordering cost, because when you bulk buy it in the bulk, your ordering cost will be less. But if you bring it to the firm, okay, then you have to maintain, you have to pay, carrying cost is more. So in this case, you have to maintain in such a way that either it should not be too much carrying cost, or it should not be, because you have to set a point where you can get minimum cost. That point is called, it's a EOQ, economic order quantity. So in that case, if you draw this gap, how many units I have to order, that you will understand. That is the point where your ordering cost, carrying cost together, it is minimum. It is minimum. Okay, this is a one problem. Let me show in your textbook when you're talking about inventory management. Page number 266. So this is a technique for, it's a inventory management, techniques for inventory management. So as I explained, ordering cost and carrying cost, both intersecting point. This is a, it's a formula. Your EOQ is whatever the notation, it is okay. Okay, but we know that what is the output and carrying cost and ordering cost. You say that one particular item, okay, 2000 units per day, and ordering cost is 10, carrying cost is 10 per 100 days, per 100 days. So the economic order quantity will be, you see, this is a 2CO, means 2 into, means it's on an average, that meaning 2 means, okay, which is 2000 units into, for how many days? These are the number of units upon, okay, what is the carrying cost? Carrying cost is 10 root. Then on an average, you have to maintain 200 units. So this is the 4 mark sum I have seen in the last previous year papers. So this is also you have to look at. And reorder quantity. What is that reorder quantity? See, in your, because of accounting software technology, What we are trying to look at every day when they are making the bill, automatically that inventory quantity will be there. From that, it is going to be reduced, and they will tell us that the system software that if minimum reaches, you just give me a signal saying that automatically purchase department will buy that. That is called reorder quantity. Sometimes a safety stock, which is called buffer stock. Okay, you have to maintain some buffer stock also, right? So this is all about inventory management, last receivable management. Once you sell goods to on customers on trade basis, you have to use the techniques which are factoring services, or you should be very stringent in that credit policy, so that you have to get the money whatever you supposed to get. Otherwise, what will happen? The bad debts can increase. When bad debts increases, that may affect on your profitability. So that's why, whether it is a inventory management, whether it is a cash management, whether it is a receivable management, it is all about it's a maintaining the liquidity, so that based on that liquidity, the profitability going to be get affected. Okay. Yeah, this is all about from my side, all about financial management. Okay, within the given time, uh, I feel I did my best. I did my best from my end, and I could able to uh,